on the expense sheet. Now let's talk about the business travel rules. And this is what is required to make sure that the IRS sees this as a legitimate business expense and you're not just traveling for personal. Remember that we have to have legitimate reasons why this is a business expense. And the first thing is it has to be a reasonable business expense, meaning that it's ordinary and necessary. So when it comes to determining what's ordinary and necessary, we just have to make sure that clients are aware of this. Like if your client is a real estate agent and they have to travel to on the other side of the state to sell a house, to show a house, because maybe they need to show a client that house or to even sign documents to close on that house. We need to make sure that the client understands that it's ordinary and necessary as part of the business. So if you have a client that could have just done something over the phone or do a Zoom call over it, well, it wasn't necessary for them to travel all the way to the other side of the state, right? So it has to be something that's necessary for the client to actually a reason why they actually had to travel. The next thing is the for only test. Now, this test really isn't talked about very much, but it's an important test where we need to inform clients like, hey, would you go on that traveling trip or would you go on that trip if there were no personal reasons at all? Like sometimes clients will travel somewhere because they could mix a little bit of pleasure in there, personal items in there where they want to visit friends or family in that location. But would they go on that trip if their friends and family weren't there, if they didn't have any personal reasons, right? So it has to be a legitimate reason of why they're going there. And pretty much they have to go there for that business reasons. And that was the main reason why they went there. And this is an important distinction to let clients know because a lot of clients are going to think, well, hey, I am going to go visit my mom in another state. And I'm just going to say that, hey, I'm there just to meet with so-and-so client just to talk to them about something, whatever that they're going to talk about. Well, that's really might not be a legitimate reason because would you have gone there if your mom wasn't there, right? So that's what we need to paint the picture in for the client to understand of what makes it legitimate. The next thing is the time test. Well, pretty much the majority of your time spent has to be for business reasons. We cannot just be there for 1 day for business and then 5 days for personal reasons. Well, that's not going to fly because it really just looks like you're there for more personal items. So we need to make sure that the client understands that the majority of the days that they're traveling has to be for business. The next one we should talk about is profit motive test. Now, in this test, this means, hey, is a client going to gain something business-wise out of this, right? We want to make sure that the client understands that, hey, they're doing this because they expect to make some kind of money off of it, whether it's now or later. So if it's to meet with the client because they think that that's going to lead to a bigger deal later on, then perfect. That's a profit motive. So making sure that there is a legitimate reasons why that client is expected to get something out of that business trip. And one of the best, I guess, examples I could give of what is not profit motive is you have this thing going around social media where, if you go to Disneyland, you could write off your whole Disneyland trip as long as you vlog about it, you do some kind of advertisement, you do something on that trip or on that vacation that's work related, then you could deduct that whole trip no matter what, right? So the thing is, this is totally wrong because just because you answer an email or you make a video while you're on vacation doesn't make it the main reason why you went on that trip, and there's no profit motive to it. You're not doing it to make money. You filming yourself at Disneyland, talking about Disneyland and trying to make it business related for 10 minutes is not going to be profit motive. You didn't go there just because you thought that 10-minute video is going to make you a lot of money, right? So we want to make sure that client understands that the reason for that trip, if they're deducting their airfares and hotel stays, is that they expected something out of it when it came to money. And the last part of this visual is we got to maintain good records. That's super important, is that if there are no records, then we can't deduct it. And when I say records, and we're going to go into more details of what is considered a record, but making sure that the client actually has the real receipts and the invoices, whether it's scanned, taken a picture of, or kept as a physical copy. As always, I always recommend clients to scan it in because physical copies tends to get damaged over time. Sometimes they actually fade. paid. So if the IRS can't see it, the IRS is not going to allow it. And remember, audits usually happen 2 or 3 years after the year that we're reporting it. So by then, the receipts can fade. So always have a digital copy if possible. And I want to emphasize is that receipts are important because clients are going to think that credit card statements or bank statements are going to be enough. It is not enough. IRS doesn't have to accept bank statements as proof because there's not enough information that shows exactly what they're doing, right? So have a receipt that shows the actual day, location, address, name of the vendor or restaurant, whatever you're doing, and the actual amount that's shown on there. Hopefully it could itemize everything out so it's easier to see, but receipts are going to be very important.